everybody, and welcome to Economics with the Honorable David M. Walker. I'll be your moderator today, Nick Calavita, but actually we have a joint moderator, and we have a very exciting topic to discuss, which of course is the economy in 2023. So we're going to bring in our co-host for today's show. Let's bring in the Honorable Kim Calhoun. Kim, welcome to the show, and thank you for moderating the other shows since I was on the road. And
I think the world missed you, Nick. I know I did.
It's life in the big city. I'm going to try not to be on the road so much. This person is not on the road, but we're going to bring him in, the Honorable David M. Walker, the former Comptroller General of the United States of America. David, welcome to the show.
Good to see you. Welcome back, Nick.
Yes. Okay. Well, yeah, it's been a little hectic traveling, but we have some important business to discuss today, which of course is the economy in 2023. Later on today, we're going to be joined by Dennis Stearns, who's the CEO of the Stearns Financial Group, which is a multi-billion-dollar money management firm. And I've known him for about 50 years, which is amazing, but sometimes that does happen. But what are we looking at in the economy in 2023? What does your crystal ball say, David? So we're going to turn it over to you.
Well, let's start off with where we ended in 2020. Excuse me. Pardon me 1 second. Let me get rid of this. Let's start off with where we ended in 2022. The GDP for the fourth quarter came out at 2.9% growth, which was better than people expected. My personal view is I expect that to be revised down when the new number comes out. But let's look at, what are some of the things that we need to be concerned about as we look forward to 2023, which we're in the early part now. Unemployment still remains low. At the same point in time, labor force participation remains low. And we saw within the last month or so layoffs, some significant layoffs, but they were primarily in the tech sector. And I think that was in large part because the tech sector probably overhired and they had to rationalize their footprint in the expectation of lower growth. Most economists, and I'm a CPA among many things, but I am not a PhD economist. Most economists believe that we're going to have a recession sometime in 2023, although the consensus now seems to be that it's not likely to be deep and it's not likely to be prolonged. But as we enter the year, we see that interest rates are still high and they are going to be raised again, I believe, by the Fed in February, although I think the Fed may be tempering their planned rate increase and re-looking at it in light of some recent data. Inflation remains high. We were at 6.5% in the latest report, which is 4.5% above the benchmark of 2%. So we've still got a long way to go. And I don't think the Fed's going to create a new higher benchmark over time. Federal spending has been out of control, totally out of control, in particular with regard to the omnibus bill, the $1.7 trillion omnibus bill that was filled with earmarks and a variety of other things. Now that the Republicans have taken over the House, I think the brakes are going to be put on with regard to federal spending. And then the question is that what's going to happen going forward, including with regard to the debt ceiling limit, which we can talk about it if you want to. If you look at from a broader perspective, not just at the federal level, but also with regard to overall debt levels going up, savings rates are going down. That's not a good indicator. And then from a different perspective, you have security issues. The Ukraine war continues to drag on. There's no end in sight. At the same point in time, we've got other security concerns that we need to be concerned about, in particular, Taiwan, Iran, North Korea, but Taiwan being the biggest. And one of the challenges that people are now starting to realize is that Ukraine wasn't armed adequately before the Russians went in. And now there's a big effort to try to get them armed now. You can't deter aggression by doing things after the aggression occurs. And now we've got a situation where we're concerned about Taiwan. Some people are coming out saying that, China might go into Taiwan by 2025. There's a huge backlog with regard to trying to arm Taiwan in advance because we've got challenges to our military industrial complex here in the United States, and we're sending a lot of things over to Ukraine that obviously won't be available to be able to send to Taiwan if necessary. So bottom line, there's uncertainty. And I will tell you this, I know you've got an investment manager who's coming on at 11:30. I wish I could stay for it, but I can't. I did look at his slides. I enjoyed his slides very much. You know, because there is so much uncertainty, one of the things that I've done recently is I've moved more into participating annuity contracts as a way to maybe give up a little bit of the upside, but protect against the downside, given all this uncertainty as we move forward.
Mm-hmm. Yeah. Well, the thing is, one issue that you did bring up, which is a problem that I see because it's a unknown factor, is the debt ceiling limit. Mm-hmm. What is I mean, you have to factor in probabilities into any type of forecast. What is the probability? It's not zero, but it's not 100% that our friends in Washington, D.C. can't get along, which obviously they love to not get along up there, and they actually default on the national debt. And then if they did do that, David, what are the short-term and long-term ramifications? Because they go, well, we're not going to raise the debt ceiling, and all of a sudden we have a default on our national debt.
Well, let's talk a little bit about what the debt ceiling is and what the debt ceiling isn't, and then we can talk about what's likely to happen, because there's a lot of disinformation and misinformation about this. You know, technically, the debt ceiling was something that was put in place back at the beginning of the last century to try to help, to try to make sure that Congress didn't have to approve each issuance of U.S. debt on a recurring basis. And what they did is they said, okay, you can issue debt up to this level, and you don't have to get our approval. But once you get to that level, you need our approval to raise it again. Well, unfortunately, we're now in a situation where Congress, on a recurring basis, ends up passing spending bills that by definition means that you're going to have to raise the debt ceiling limit. And things have just gotten out of control. Obviously, one of the reasons that they wanted to have a debt ceiling, and by the way, we're the only major industrialized nation, to my knowledge, that has a dollar-denominated debt ceiling. One of the reasons they wanted to do it was not just a matter of convenience for the Congress, is they wanted to have a way to try to be able to control federal spending and mounting debt burdens. Well, it has failed miserably in that regard. And so, but let's talk about what it is. It says you can't engage in additional spending if you hit the debt limit. Let's talk a couple of things about that. First, there's only one thing guaranteed by the U.S. Constitution that's a financial obligation, and that's principal and interest on sovereign debt of the United States. So we're not going to default on that. And people who say that we are going to default on that don't know what they're talking about. The second thing is that people want to have the sky is falling with regard to Social Security and Medicare. The fact is, the bonds that we have in the so-called trust funds for Social Security and Medicare are already in the debt ceiling limit. And therefore, to the extent that we have bonds, which are non-readily marketable bonds, in those trust funds, then we can still make Social Security and Medicare payments until those bonds are exhausted. So then from a practical standpoint, what would end up happening? Well, you couldn't end up making other payments, whether that's, you'd have to cut back. It wouldn't be zero. You'd have to cut back significantly in other payments to contractors, payroll, whatever it might be. Obviously, we want to avoid that. My personal view is we're not going to allow that to happen, but it is very appropriate, in my view, that that negotiations be taking place, not to determine specific reductions in spending levels as part of the debt ceiling. That's not the appropriate mechanism for that. But one of the things that I think is appropriate is that we recognize that we are out of control and that we have got to create a mechanism that will put us back in control. And I think there are a couple of ideas that I have on that, one of which is, as you know, we passed the threshold for a state-led Convention of States to propose a fiscal responsibility amendment back in 1979. And there is a new resolution that's going to be introduced both in the House and the Senate to raise more visibility to this. Maybe we could force a vote on that resolution as a way to wake people up and recognize what's going on. The other thing that we're going to have to do is, look, they're ultimately going to have to make very tough choices about Social Security, Medicare, Medicaid, other mandatory spending, defense, and other discretionary spending, and revenues. And all of those are going to have to be on the table because we're way past being able to grow our way out of this problem. To do that, they're going to need some type of a public engagement process that sets the table for a tough vote. And I think what we need is that we need a fiscal sustainability commission that would be comprised of capable, credible people who would engage the American people with the facts, the truth, the tough choices, listen to what they have to say, come back, make a package of recommendations, guaranteed a vote in Congress. And then this needs to be statutory. It needs to be law to where the Congress buys in, the president buys in. That's going to be necessary, I think, for us to get to where we need to be. And I think those kinds of things are very appropriate to put on a debt ceiling limit because they're like a wake-up call and they're providing a mechanism for a way forward where we can start making some intelligent choices. Because the idea that you're going to be able to do all needs to be done through the regular order in Congress is a bad joke. That ain't going to happen.
Mm-hmm. Yeah.
By the way, Nick, one other thing.
Sure.
The so-called Simpson-Bowles Commission, which I know that you and Kim are very familiar with, back from 2010, okay, they did very good work, but they didn't meet any of the criteria that I just said. Mm-hmm. And therefore, we need to learn from the past and others, and we need to prepare for the future. And in this regard, those are some of the changes we need to make.
Yeah. Well, Dave, another question. Why isn't this issue front and center on media every day? Because what I look at, the fiscal responsibility of the United States of America is the most important obligation that everybody suffers from or benefits from. And yet, when we pulled the congressional record, and this really irks me, they were discussing in Congress how great the University of Georgia Law School is. They shouldn't be discussing it. It's not that important. They have a good football team, great, but you don't discuss that in Congress. Come on, David. Why aren't they discussing this issue? Why aren't there hearings today on the fiscal responsibilities of the United States? Because we've gone over it in our program. Why isn't the media covering it? Well, they're not discussing it. So there's nothing to cover. But we're looking at Social Security going insolvent next decade, Medicare going insolvent this decade, our national debt increasing at $1 trillion a year for the next decade. And we're like, hey, let's go talk about murders in Memphis. I mean, I don't get it. When this should be and not to say that's not an important issue, but this is an important issue that affects everybody in the United States, and we ignore it. What's going on?
It doesn't just affect everybody in the United States. It affects the global economy.
Yeah.
And so, look, unfortunately in Washington, the system is afflicted with three maladies. Number one, myopia or nearsightedness. They're just focused on the here and now. Secondly, tunnel vision. They only can look at one issue at a time without understanding the interconnectivity, the interdependency, the domino effect, if you will. And thirdly, self-interest, namely getting reelected. Mm-hmm. The fact is that they don't want to make tough choices on spending and taxes unless they're forced to. And that's why I say we need a forcing mechanism, and we need a mechanism that will be able to engage the American people, set the table for a tough vote. Now, here's some good news. The new chairman of the House Budget Committee, Jody Arrington, Republican from West Texas, is very much committed to fiscal responsibility and sustainability. He was the lead sponsor for the resolution that I referred to before on a convention of states to propose a fiscal responsibility amendment. He's committed. He's going to be the lead sponsor this time. He's obviously in a much stronger position this Congress than he was the last. I'm cautiously optimistic that I'm going to be testifying before the House Budget Committee. And I can assure you that all the issues that we're talking about and more will be brought to the table.
Right. Yeah. And I'm hoping that the media will actually cover these issues, but also do we have an education problem in the United States that I just got back from Las Vegas, and let me tell you, here was the problem. Okay, David, the tables were full of people. The casinos were full of people. And anybody who knows anything about math, you're throwing your money away, basically. And to the point where I was going, one way to solve the national debt is have a national lottery, because there is a group of people that love to throw their money away. I just don't happen to be one of them. So I'm not really a good person for any casino because I just don't gamble. But the thing is, these people are just completely throwing their money away daily. And I started thinking, I said, well, there's only two ways that I know of you can solve this debt problem. You either have to raise revenues, and raising revenues, you could have a national lottery. They had a state lottery in Georgia, which basically funds free tuition to any Georgia college, like Georgia Tech, University of Georgia. It's really great. But you have to either do two things: you raise money or cut expenses, or do a combination of both. It seems to me that the people in Congress don't even know basic finances, let alone sophisticated mechanisms to get us out of this hole that we're in. And so what they do is they just ignore it. Is there any way that we can educate Congress a little bit on how to solve this problem, or even recognize it is a problem?
We're going to have to do several things. We're going to have pro-growth economy, pro-growth policies, all right? It's not just with regard to fiscal policy, but also with regard to regulatory and other policies, including energy policy, because we want to grow the denominator in debt to GDP faster than the numerator. And you can do that even if the numerator is growing, if you grow the denominator faster than the numerator. However, our financial hole is so deep, there's no way you can grow your way out of the problem. So we're going to have to restructure social insurance programs to make them solvent, sustainable, secure. We're going to have to reprioritize and reduce projected spending for discretionary programs. And we're going to have to engage in comprehensive tax reform that will generate more revenues as a percentage of GDP. My wife is, I'm not a gambler either, because I know something about math as well. And, and my wife has been a longstanding proponent about having a national lottery. The only problem with that is the hole's just way too deep for that to make a big difference. Secondly, the states would probably be against it, because that's how they're trying to raise money now, right? So there's only so much money around. Where's the money going to go? But we are going to have more revenues. And by the way, not all tax cuts stimulate the economy, and very few tax cuts pay for themselves. Now, what I mean by that, I mean that you generate more revenues than otherwise you would have if you didn't make the changes. Now, a lot of people provide disinformation on this. They say, oh, well, we got more revenues after we did these tax cuts. Well, there's something called bracket creep, okay? I mean, you can get more revenues or because of changes in the markets, where you have a good year in the markets, and therefore you have acceleration of revenues that otherwise you might not get until future years, if you will. So, yes, we need to educate Congress, but here's the other good news. I don't think there's anybody in the country that's done more citizen education engagement on these issues than I have. And the people are way ahead of politicians.
Yeah.
They know we're not exempt from the laws of prudent finance. You can't spend more money than you make, charge to the credit card, and not to have a day of reckoning. All the more reason why I come back to, you've got to have a forcing mechanism that will force them to make tough choices. That's a constitutional amendment. It won't work with anything other than that. And you've got to have a mechanism that will engage the public meaningfully, set the table for a tough vote. Now, here's the thing. The politicians don't think that the people can handle the truth. They don't think they would be willing to accept tough choices. They're wrong. Right. All right. And look what happened on Simpson Bowles. They did good work. They did no meaningful citizen education engagement before they come up with their recommendations. None. After they came up with something, they went out and tried to sell it. That's not how you get things done.
Yeah.
And confidence in government right now is about at an all-time low. So we got to do things differently.
Right. You do have to engage people in terms of that. And even just looking at, but I think they should have hearings, and just like they had this big thing on the January 6th commission, they should have hearings on Social Security, Medicare right now. Because actuarially you can solve it earlier, but if you wait till later, it's going to be a hard situation to solve. And unfortunately, they're going to have to give news that people will like to hear, such as and what happened. I think Leslie Graham said, "Oh, we should move the Social Security age to age 70." But there are ways you can tweak it to make it better. The work that I do, being a lawyer, I can work to age 70. It's no big deal. It's not, Frank. I'm not going to say it's not hard work, but basically, it's not hard labor work.
It's not.
But if I was, you know what I mean? I hate to say it. It's not.
Yeah,
hard
I
work.
get
Okay, but the thing is, if I was in a trade, and I was out doing construction work, for example, then at age 70, that could be a hard time to force that to be the normal retirement age. So they should actually test for people like me that Social Security could be longer, or frankly, not exempt at all, because some people make too much money. It doesn't matter if they receive Social Security or not. And some people are forced to live on it. There's no means testing. There's no changes in age. And frankly, there's no discussion about it, which means there's the result, our Social Security system goes insolvent in 2 decades.
Okay, let's talk a little bit about Social Security. Okay, as
Yeah.
you know, among other things, I was also a trustee of Social Security Medicare for 5 years. All right, and there's a lot of disinformation and misinformation about Social Security as well. First, you are correct to say that early in the next decade, and I think the date will move up, that the quote unquote trust fund, and I like to put that in quotes, trust the government fund, okay, will go down to zero. Now, what happens when it goes down to zero? There's still money coming in. There's not enough money coming in, all right? So your negative cash flow, you would have cashed in all those bonds that we talked about earlier. And so you would have to immediately cut benefits across the board, 22 to 25% across the board, and that percentage would go up somewhat over time if you do nothing. Here's my frustration about Social Security. Based on extensive work that I've done, the fact is that we have an opportunity to exceed the expectation of every generation of Americans in Social Security reform, and we ought to do it sooner rather than later. Why? Because seniors think they're going to get taken advantage of. There are other words that I could use, but I won't use them on the program. At the same point in time, young people don't think they're going to get anything.
Right.
They're both wrong. It would be inequitable and politically infeasible to do something for people who are in the program, already retired or close to retirement, and young people are going to get something. The question is, how much are they going to get? At what age are going to get it? And at what tax rate are they going to have to bear in order to get it, right? I worked with Bill Clinton in 1997 to try to pave the way for Social Security reform. And we would have had Social Security reform while he was in office, but for the Monica Lewinsky situation, where he lost all of his political capital. George Bush tried to do Social Security reform, but he forgot the second word in Social Security. It's not opportunity, it's security, all right? Because, a very significant percentage of the population relies solely on Social Security for retirement income. It was never intended to be that way. Here's what's likely to happen, Nick. What's likely to happen is you're not going to raise the early retirement age, okay, because you've got some people in certain occupations, they need access to that. Although a lot of people that are in those occupations have pretty good pension plans, okay? I mean, better than average, all right? Secondly, you are, I think, going to raise the normal retirement age gradually, probably another 2 to 3 years, over 20 to 30 years gradually, okay? You're going to see a significant increase in the taxable wage-based cap, all right? You're going to see a change in the benefit structure so that people that are close to the poverty level or lower income will end up getting a higher replacement rate. People that are upper middle and upper income will get a lower replacement rate. But you're not going to turn it into a welfare program, because that would end up undercutting support for the program. You're not going to fully means test it, if you will, because that would make it a welfare program, and we got too many welfare programs already. So, and you're going to look at the cost of living formula and determine whether or not there ought to be a change on that based upon the differences in a basket of goods, depending upon your age and your life cycle, if you will. So those are some of the kinds of things that are likely to happen. And those type of reforms got 77% support from representative groups of voters on the tour that I did around the country. And, that's even more than a veto. I mean, that overrides a veto.
Mm-hmm. Yep. Well, we've been joined by Dennis Stearns, who's the CEO of the Stearns Financial Group, who's going to be giving us the economic forecast. I just want to do one more issue with David before
Sure.
he has to go. And this deals with an important topic called Medicare issues. We're seeing Medicare going insolvent by the end of this decade. Is there any talk in Congress about Medicare reform, or are we just going to let it just puke out by the end of this decade, which is only several years from now, by the way?
Yeah, well, the latest projection is the Part A program, which is hospital insurance. Okay, Medicare is several programs. It's Part A, which is hospital insurance. It's Part B, which is supplemental medical insurance outpatient physicians. It's Part D, which is prescription drugs. And some people, including my wife and myself, have Part C, which is Medicare Advantage, which is a hybrid. A is the one that's going to go to zero by 2028, maybe accelerated when the new report comes out. And something needs to be done, but we need comprehensive reform because we've way overpromised on healthcare, way overpromised. And yes, the date for that is sooner than Social Security, but that would be within the scope of this Fiscal Sustainability Commission that I talked about as well.
Mm-hmm. Right. Okay. All right. We're going to bring in Dennis Stearns, the CEO of Stearns Financial Group, to give us a economic forecast. Hopefully, some good news in 2023, Dennis, because it seems to me 2022 was bad, but not as bad as people thought. So let's go take a look, and I guess we have your presentation, correcto? Up here, just a minute. Padam. There we go.
Dennis, can you give us the bottom line before I go?
Yeah.
Yeah, the bottom line, Dave, is things are actually looking better, but not great, short term anyway. Certainly a lot of intermediate and long-term issues percolating out there, as you have already mentioned. And, inflation is one of the biggies. And don't know that we're completely out of the woods, but the latest inflation number in December, again, everybody looks at the last 12 months, look at the month over month, and that number was actually a negative 0.1%, mainly because of gas prices coming down. Yeah. But then you look under the hood, and the number for shelter, which is always a big one, whether it's renting or owning, that number was 0.8% for the month, which you multiply that by 12, and it's not a great number, 9.6% annualized. But everybody knows that's a lagging number. And so you look at the present day number of different housing metrics, and it's probably flat or negative in many cases. Now, we still think rents are going to be above average growth, but they won't be the double-digit rates. So is inflation under control? Yeah, it's getting there, and may not be the big boogeyman that we thought it was last year.
Well, thank you. I wish I could stay for the whole thing, but I did look at it and enjoyed it. Thank you very much.
Yeah, thank you. So, getting on to what moved markets in 2022, talked about inflation. And again, that's the backward-looking 12-month number, which as we go into 2023, again, I think that number will be radically lower. Central bank policy, that's been a big one. And the Fed, don't fight the Fed thing, Fed funds rate has moved up very, very quickly. And part of that is the reset that we were expecting. We talked about it a year ago, that we thought there was going to be a reset on Fed funds rate, interest rates going up, a reset then in price earnings ratios in the stock market, both in the US and around the world. Well, that geopolitical unrest, Ukraine, when Russia invaded Ukraine and energy prices shot up, a lot of other inflation numbers shot up, all of that pressed the Fed to move interest rates higher faster. And it was shock therapy. Maybe not quite as bad as Paul Volcker back in the 1980s, early 80s, when the shock therapy almost killed the patient twice, but it was pretty bad. And as we'll see later, 95% of asset classes were negative in 2022. And then finally, the residual impact of pandemic policy, again, US and around the world, it's still lingering effects back in 2022 on supply chains, tight labor markets. Some of those tight labor markets certainly do persist today. And, again, this gets you to that most asset classes down in 2022. Now, if you were lucky enough to have commodities, and particularly energy, oil, natural gas, which been one of our favorite areas, you were better. But pretty much everything else was a negative return last year. And one of the remarkable things, again, is both stocks and bonds down at the same time. And that does not happen very frequently. We literally had one of the worst stock and bond combined returns in history. You almost have to go back beyond when we keep modern numbers to see stocks and bonds both down at the same time, the magnitude that they were last year. So that got into what we talked about a year ago, that if all you're using is chocolate and vanilla, stocks and bonds in your portfolio, it's good to have some alternatives in there. And we'll talk about that towards the end, strawberry, butter pecan, other kinds of flavors of ice cream. And this is just a reminder that the stock market has long periods of outperformance, and it's then punctuated by these red periods of, oh my goodness, bad times, but they are much shorter in duration. So it is still true that the stock market, closely aligned with real estate, is particularly income producing real estate, is one of the greatest wealth producers of the last century. And it's because of what you see on the screen, these long periods where the stock market does fine, and then short periods that scare the bejesus out of everyone. Bonds, again, had a really bad year last year. And again, these statistics, we're going back to 1926 for these statistics, that the worst bear year for bonds was last year. And that's on the far left of this chart. You then had a few years where you lost money, 0 to negative 10%, and then less than average. Again, average over a long period has been 5%, and that's the yellow line. That's the highest number. But then average return 3 to 7 is the second highest. Again, 28 years versus 29 years, so pretty close. And then you had a number of years, and this is usually where you had high interest rates going to low, and that's the purple and green on the far right, where bonds made more than normal. So I've heard a lot of people say, oh, bonds are dead and bonds don't make sense anymore. Well, they're making some more sense now. And even though we just came off of one of the worst years literally in the last 100, bonds do make some sense in a portfolio. I will say that just as last year when we had this discussion, we were underweight stocks coming in, we were underweight bonds. Well, we're still underweight bonds. So even though the returns are more interesting, they're just not interesting enough for us to go to a normal weight, even though they do play. I think they'll play better defense going forward. That is one of the keys. And so potential headwinds in 2023, you just got a primer from Dave on U.S. government debt. In our opinion, that debt issue has been way off in the future, and now that future has been brought forward a bit more. Not necessarily going to have huge impacts on securities markets in the next year, 2 or 3, but those issues are coming up. Again, central bank policy will be key this year, not only in the United States, but around the world. What will central banks do? Again, I think central banks, because of that inflation beginning to look better, and again, not just in the US, all other countries around the world, I think that many of them are going to back off. But central banks have a tendency to overshoot, and they just hate inflation. They will stamp out inflation at all costs, and even if that means sending us into a recession. And so, again, I think that's a risk. Geopolitical risk is still there. Ukraine, certainly Iran, China, a lot of issues with China. Now, you'll find China in the tailwinds as well. We'll talk about that in a second. But the fact is that the supply chain problems with China were huge last year. They're getting better, but they could still be some issues this year. And then that potential recession, we just had some not so great economic numbers in Germany, but we had some better economic numbers in the United States. Maybe we're going to avoid a recession in the US. Our official forecast is a mild and short recession. But again, a lot of the data is trending towards maybe it's not going to be even quite that bad. But it is remarkable. We've just had several surveys of CEOs of major public companies, and 99% of those company CEOs have said short and mild recession. That is a remarkable number. Usually 99% of anything, it doesn't come true. That's been my observation. So again, maybe it's a little better, but there's still some data out there that we're tracking, could, again, some of these issues and a few others that could send us in the wrong direction. But right now, data is trending in a relatively positive direction. And again, you get to this government debt maturity profile. You can see that the U.S. government debt by maturity, we are refinancing literally 50% of the outstanding U.S. government debt in the next 3 years. 50%. That is incredible. And that 50% is at a pretty low interest rate. You can see there that the weighted average coupon rate on that debt, 1.7%. Well, we know when that's refied in the next 3 years, it's going to be higher, and it's going to make that weighted average go up. And so, why the U.S. government didn't push more of their debt out longer when interest rates were low. We know some of the reasons that they felt like the demand was stronger in some of the more intermediate and shorter term, and they could get the financing done easier. I mean, they were even investigating 50-year bonds, which again today sounds crazy, but it wasn't that many years ago they were investigating refining some of it at 50-year bonds at 2%. And today that sounds like it would have been genius, but didn't happen. And so this again is a reminder that things are not great on that fiscal debt front, but they've been worse. So this is the federal net interest cost percent of tax revenue. So again, in past years, when I've been on with you, I've talked about never look at one number. If you fixate on one number, you're probably going to get in trouble. Always compare it to a second number or a third number. And so you have some texture. Well, this is comparing it to tax revenue. Sometimes federal debt costs are compared to GDP, gross domestic product, or other things. But as a percent of tax revenue, you can see that we were in deeper doo-doo in the early 90s. And we had a lot of decline in that percent of tax revenue And you can see on the right-hand side, starting to trend back up. And again, unfortunately, I think because of some of the realities of that debt refinancing I just mentioned and some other things, we're probably going to trend up some more. Dave, I think, talked about fiscal responsibility. Unfortunately, there are some members of Congress that are now talking that game more, but it wasn't too many years ago where no one on either side of the aisle was really talking about, where our debt is. And so this is a freight train we need to get in front of. Again, I know you just had an earful of that from Dave. And again, this is the so-called dot plot that the Federal Reserve, the people who actually vote, are doing on where they think interest rates are going. A remarkable little piece of this history is that the voting members on the Federal Reserve, as we came into 2022, now, again, they could not necessarily have anticipated that Russia was going to invade Ukraine and create all kinds of weirdness, and that China supply chains were going to create all kinds of weirdness, and again, this imbalance between demand and supply. But a majority of the voting members of the U.S. Federal Reserve failed to anticipate exactly where we were going to end up for the end of 2022. So again, you would say, well, does that mean we should take this with a grain of salt? Well, again, it's a data point. It is not the data point, but it is an interesting data point to see where the Fed, the folks voting, actually think we may end up. And again, they think we're going to end up a bit higher at the end of 2023 on the Fed funds rate, but our suspicion, not hugely higher. So this is not going to be a replay of Volcker in the 1980s. That seems to be a pretty good probability at this point. This is one we've really got our eye on, and this is, again, in the headwinds category, is earnings expectation. So a lot of companies we talk to, public companies, private as well, but a lot of public companies, they're having margin pressures, profit margin pressures. And some of it's the higher cost of labor, and they got to pay up to get labor. And some of it is some of the inflation coming into their supply chain. Some of it is just realities of the marketplace. And again, I think the good news, we just talked to some folks in the retail industry. There was a survey done of a lot of retail companies who experienced about 6% inflation in their supply chain in 2022. They're expecting 3% in 2023. So that's maybe better news on this profit margin front. We are in earnings season right now in the U.S. stock market, and it's a mixed bag. We've got some companies that are doing okay, and their forward guidance is okay and above average. But as this chart shows on the far right, expectations on average have come down a lot. And there's a few companies that are going, we're not sure if we're going to break even, meaning have the same amount of earnings this year as last year, or maybe even decline our earnings a little bit. And so for the S&P 500, that decline, we're not saying negative earnings on average. What we're saying is, well, it could be $215 a share if you go across all the companies in the S&P 500. That would actually be an earnings recession. That would be down a little bit. And that would cause a fair amount of additional volatility in the stock market. Right now, our best guess is that data is going to trend towards maybe a flat, but it's company by company. And so again, this is where you look at the stock market, but some of the individual companies are going to have better or worse than average results. Recession watch, again, most anticipated recession in history. Again, remarkable, this chart that we're looking at. And again, what that suggests is, well, if everybody's thinking it's going to happen. Will it really happen? Well, this is one of those that it can become a self-fulfilling prophecy. So if enough companies think we're going to have a recession, they start trimming a bit. They trim 3% or 5% of their workforce. We've seen that with a number of companies. Or they trim their marketing budget, or they trim a few other areas. Consumers, if they think a recession's coming, they trim here, they trim there. Maybe they don't make the house purchase, and particularly with the higher mortgage rates we have today. So if enough people do all that, you've just got the recession that you feared. And so, again, this is one of those reasons why we're not saying that we're out of the woods on having some kind of at least mild recession. Tailwinds, again, valuations are better. Wouldn't call them cheap, but they're better. Trend in inflation, we've already talked about, certainly better. And China reopening, this is extraordinarily helpful for the supply chains in the United States and a whole lot of countries and companies around the world. It's also great for Europe. I mean, part of the reason European stocks are on fire, doing great right now, part of the reason is the anticipation that they're going to have a lot of Chinese tourists coming back to Europe, spending a lot of money. And also, many of those European companies work in China. In fact, larger percentage of them have very close connections to China compared to United States companies. So China reopening, pretty big deal. As everyone knows, it's a little bit dicey right now for the Chinese people because of all the unfortunate COVID things that have been done. And again, who knows for sure why China would just simply snap their fingers and say, oh, okay, all our restrictions are off. Why they didn't do some sort of transition plan is beyond me and a lot of China experts I know. So because it's just creating havoc. But anyway, it is what it is. Again, change in valuations, S&P 500, one of the reasons we were underweight stocks coming into 2022 is we felt that number was stretched, the 23 times earnings for the S&P. 19 times earnings is still not bargain territory. And so, this is not 08, 09. We're not coming out with a bunch of companies that are on fire sale. There are some fire sales out there. Certainly the semiconductor area has been a fire sale. The number one area, by the way, that we'll talk about a little bit is the U.S. stock energy area has the highest free net cash flow of any other sector in the S&P 500. And then 10-year treasuries, have come up a bit. And again, that's the 10-year. You can get a 1-year treasury now for 4.8%. So if you have money sitting in a bank at 0.2%, look at that 4.8% on a 1 year. That's a pretty darn good number. And CDs are back in play. We haven't seen CDs at reasonable rates in almost 15 years. Again, inflation, I think we've already talked a lot about that. Numbers are trending better. State of the economy, a lot of things in that annual wage growth area have been positive. If we do have a recession, it will be one of the strangest recessions possibly ever, because gross domestic income in the United States is at record numbers. That's the total number of people working and actually making income. Normally in recessions, you have the exact opposite. You have a lot of layoffs. You have income actually coming down. Gross domestic income, just a reminder, was the number one predictor coming in to 08, 09. Gross domestic product was not predicting that 08, 09 would be quite as bad as a Great Recession that it was. But gross domestic income was predicting that it was going to be pretty nasty. And so right now, again, latest gross domestic income numbers up. Now, the latest gross domestic product number for the United States is also up. So at least right now, we're not it doesn't look like we're in a recession, or if we are, again, it's a very odd recession. So opportunities in 2023, we do think there's select opportunities in stocks. Like I said before, wouldn't say that they're bargain, wouldn't back up the truck and go overweight at this point. But stocks are looking better. Bonds, as I mentioned, better, but not tremendously better. Private assets, pretty good. I mean, a lot of the private asset categories still look pretty good. We'll talk about some of those in a second. And cash, short-term money markets actually making some money again. So yay. U.S. stocks following returns following recessions. Again, are we in a recession? Are we going into one? Who knows? But what you can see here is that even if we have some kind of recession, the returns are generally a bit better after recessions. Now, this is one of those where looking at the stats, we would push back a little bit that returns are going to be spectacular because our valuations are still not at a great bargain point like they are in many recessions. And we have higher interest rates, which automatically resets price earnings ratios a bit lower. So there's just a lot of factors that make us think that what you're looking at on the screen, we'll have decent stock returns, but they may not be above average. Outlook for bonds, again, has improved where we are right now. Starting price matters, whether it's stocks, bonds, real estate, or any other asset class. Well, we're right now in that green sector in the bond market. And that green sector, you look over to the left, well, what does that predict over the next 5 years for bond returns? Well, it predicts that, maybe we'll be somewhere in the 4% on average range. And so not bad, not great. And if you're trying to make real returns over inflation to prepare for retirement or in retirement, again, that's not a good recipe in terms of inflation adjusted returns. So improved, you should take a look at bonds maybe again, but I wouldn't go crazy with them. And this is that famous 60-40 portfolio, 60% stocks, 40% bonds, which again had a really nasty year last year because both stocks and bonds were down. But following the worst 10 years, these are the returns in that 60-40 portfolio. And you can see they look much better. So, I've heard a lot of people say 60-40 is dead. Again, a year ago and the time before that, with this audience, we talked about the fact that we had a modified 60-40. We have different kinds of things substituting for bonds. We have different kinds of things substituting for stocks. But I think after the reset last year, chocolate and vanilla is not going to do too bad going forward. And so that gets into some of these alternatives. Again, we don't have time to go into a lot of depth on all of them, but private real estate still looks good. Now, there has been a bit of a reset in income producing real estate. So remember, that's different than, perhaps single family homes. But we do think they'll have decent returns over the next 3 to 5 years. Private credit, decent returns over the next 3 to 5 years. Private equity, decent, maybe even better than decent. Multi-sector private alternatives, amazing number of tools available in that area. And then venture capital. There's a lot of innovation that's needed in the world. A lot of big companies rely on small companies to come up with their innovation. And so venture capital is starting to look more interesting. And this is that trailing risk reward chart we've looked at before about how do some of the asset classes like timber, like farmland, like private infrastructure, how do they do over time? Well, that's that circle over on the left. They have a lot lower risk than the stock market, which the stock market is that triangle on the very far right. So pretty decent returns in the U.S. stock market, but big volatility measured by standard deviation. So a lot of these other things have produced pretty solid returns, in some cases even better than stocks, and have done it with a lot lower volatility. We think some of that's going to continue even with some of the reset that we saw in 2022. So that's it, Nick.
Well, it looks like we have a challenging year ahead trying to figure that out. The biggest thing I saw was that refinancing of the national debt. If you got to zero in on that, Dennis, I didn't know it was going to be that large, 50% of the national debt being refinanced. That's incredible, in the next couple of years.
Let's find the CFO of the United States and fire them for not getting ahead of that train.
I was going to say they should have gone long term on that. But it also looks like if the interest rates start going down, I guess the best time to buy real estate would be not now or not this year, but the next couple of years if the interest rates go down. In other words, so where you would start acquiring debt again. So
I experienced something interesting because we had the interest rates go down for quite some time, which was great. And a lot of people dove in and started buying. But at the same time, the real estate prices, like just price gouging like crazy, just went up and up and up. And right at the time that the interest rates started to go up, oddly enough, the prices went down, and my son was searching for a place to live about that exact moment. So we kind of seized the opportunity when the cost of properties were going down. Even though the interest rates were high, we said, you know what, it's best to buy the properties while they're down, and we'll refi when the interest rates go down, because that will happen. We see this cycle all the time. So I think, there's windows of opportunities on both sides of the tracks. You just have to look at what's positive for you at the time. I would rather pay less for property today and watch the value go back up tomorrow and refinance tomorrow. But other people have a different way of making money on it, doing it reverse. I think there's ways to make money both. What do you think, Dennis?
Well, I agree. And Royal Bank of Canada's, their forecast for the reset in the single family housing market has not fully played out yet. Now, Canada, again, had tremendous inflation in single family homes, and they were predicting 30 to 40% retracement down of home values. And there's been some retracement, but the issue we have in the United States is we still have a housing shortage most places. And so, what are Gen Zs coming out of college making pretty good money, by the way, because of the labor shortage? What are they going to do? Well, with 6% mortgage rates, I mean, that's the good news, is mortgage rates have actually come down. They were above 7 and they've come back down to 6. Historically, for those of us who have a little longer term vision, 6% isn't all that bad, but 6% still looks radically bad to a Gen Z coming out of college. But can they even afford the down payment on some of these homes that have only come down 5% or 10% in some markets? And some markets, in some of the markets that we're in, housing demand is so high, they haven't even come down hardly any. So again, we're sailing in uncharted waters, and some would say weird waters right now.
Right. Yeah. And with that, we're at the hour. So I'd like to thank our special guest, the CEO of the Stearns Financial Group, Dennis Stearns, who manages somehow more than $1 billion worth of assets, and also the Honorable David M. Walker, the former Comptroller General of the United States, and with a very special report on the economic forecast in 2023. And we'll see you all next week on economics.
Great to see you, Dennis. Thank you.
You all.
Thank you, Dennis.